The Fibonacci retracement is a tool based on the Fibonacci sequence. It provides multiple horizontal lines on the chart, showing potential pullback or retracement levels where price might reverse. Among these, the 0.5 and 0.618 levels are the most important, as price tends to react strongly around them. So, once you apply the Fibonacci tool, if you find a support or resistance level around the 0.5 or 0.618 zone, that area becomes significant. For example, here we have a support level aligning with the Fibonacci level. Price retraces back to this level and forms a long wick rejection candle. Once price breaks the high of that candle, it indicates a possible move upward. Next, breakout patterns. In this scenario, the market is moving within a range, and then it breaks out in the direction of the existing trend, continuing the movement further. Using breakout patterns, we can plan high probability trades. Some of the most popular breakout patterns are the flag pattern and rectangle pattern. The key point is, when these patterns are traded in the direction of the trend, they tend to give very strong results. Next, reversal patterns. A reversal occurs when price changes its current direction. For example, when the market shifts from an uptrend to a downtrend, that's a reversal. We can identify these reversals using certain patterns, like double top, double bottom, and head and shoulders patterns. For example, suppose we have a key support level. Price revisits this level and forms a double bottom pattern. According to the pattern, once price breaks the neckline, it indicates a possible bullish reversal, and we can look for entry opportunities. Next, fair value gap. When there's an imbalance between buying and selling, a fair value gap, FVG, appears on the chart, an area that often acts as a magnet for price. Price tends to revisit this area before continuing its move. To mark a fair value gap, we need 3 momentum candles. For example, in an uptrend, you'll see 3 consecutive bullish candles. Check if there's a gap between the first candle's high and the third candle's low. If those two don't overlap, that's our fair value gap. Then, when price retraces into this gap and forms a bullish long wick candle, it signals potential reversal and continuation in the direction of the original trend. Next, candlestick patterns. Candlestick patterns are specific candle formations that help predict future price movements. They are categorized into bullish and bearish patterns. One common mistake traders make is trading every candlestick pattern they see on the chart. This is incorrect. A bullish pattern should only be traded from areas where upward movement is likely, such as support levels, demand zones, bullish fair value gaps, bullish order blocks, or around moving averages during an uptrend. Similarly, bearish candlestick patterns should be used at areas where downward movement is expected, like resistance, supply zones, or during downtrends near moving averages. For example, if we see a bearish long wick candle at resistance and price, then breaks that candle's low, that serves as a confirmation for a sell entry. Next, RSI divergence. The RSI, Relative Strength Index, is a momentum indicator. RSI divergence occurs when price and RSI show opposite signals. For instance, price forms a higher high, but RSI forms a lower high. This means that even though price went up, momentum is weakening, suggesting a potential reversal. However, RSI divergence alone is not an entry signal. It should be used to confirm price action setups. For example, if a double bottom pattern forms at a support level, and at the same time RSI shows bullish divergence, it strengthens the probability of reversal. Similarly, when price approaches a major key level and divergence appears, we can look for confirmation using candlestick patterns before entering trades. Next, support and resistance. Support is a level where price tends to bounce upward, while resistance is a level where price tends to reverse downward. But how do we confirm if price will actually reverse? You need to observe the reaction at those levels. Is price respecting the level? Is it slowing down near the level? Is it forming rejection candles? For example, if you see a long wick candle at support, it signals rejection, meaning price tried to break lower but failed. That indicates price is reacting to and respecting the level. For confirmation, you can use candlestick signals. If a hammer forms at support, wait for its high to break for a long entry. If multiple long wick candles form, it confirms rejections. Even doji or indecision candles at key levels signal hesitation and possible reversal. If candle sizes start shrinking as price approaches the level, it means momentum is fading, another sign of respect for the level. Based on these reactions and confirmations, you can plan your trade accordingly. Next, dynamic support and resistance. The lines we manually draw on the chart are static. They don't move with price. But moving averages act as dynamic support and resistance. During an uptrend, they act as support, and during a downtrend, as resistance. Which moving average is best? It depends. Every trader uses different settings. There's no universal rule that a 50-period or 40-period moving average will always work. You should first observe which moving average the current trend has respected at least 3 times. That's the one working best in the current market phase. For example, if price has already respected the 50-period MA 3 times, that's our active level. Next time price comes near it, observe the candlestick behavior for confirmation and potential entry. Next, trendline trading. A trend line is a diagonal line connecting at least 3 swing points. An upward trend line means the market is bullish, so we look for buying opportunities. A downward trend line means the market is bearish, so we look for selling opportunities. In an uptrend, the trend line acts as support. In a downtrend, it acts as resistance. For example, if price has reacted to a trend line multiple times in the past, there's a probability it will do so again. So next time price touches that line and shows a bullish signal, we can look for a buy entry. Next, volume-based trading volume shows the strength behind a price move by analyzing traded quantity. 1. Volume bars. Each bar shows the volume of its respective candle. Low volume on a breakout candle often means a false breakout. High volume confirms a genuine breakout. 2. Volume also indicates strength. If price is rising but volume is decreasing, momentum is weakening, possible reversal. If price and volume both increase, momentum is strong, price may continue higher. Another useful tool is the volume profile indicator. Its horizontal bars show price levels with the highest traded volume. These high volume zones act as key levels for potential trade setups. Next, demand and supply. Trading demand and supply zones are areas where institutions place large buy or sell orders. But how do we identify them? Institutions leave footprints in the form of strong momentum candles. Big moves that retail traders cannot create. These large candles indicate institutional activity. For example, in an uptrend, find 3 strong bullish momentum candles. The weak candle before them marks the origin of the move. Draw a zone around that candle's range. That's your demand zone. When price returns to this area and forms a bullish candle, you can plan a buy trade. Similarly, identify supply zones using the same logic for sell setups. Next, false breakout trading. You've probably seen price break a level, triggering entries, only to reverse later. That's a false breakout or breakout failure. Smart traders use this situation to their advantage. For example, if price breaks above resistance but quickly falls back below, it indicates a failed breakout. Many traders' stop losses get hit here, creating liquidity, which fuels the next move in the opposite direction. So when a breakout fails, you can plan a trade in the direction of the failure. So these were the major trading concepts, from Fibonacci retracement, breakout and reversal patterns, to RSI divergence, volume analysis, demand and supply zones, and false breakout setups. Hopefully, you learned something valuable from this video. If you found it informative, make sure to like the video and subscribe to the channel. We'll see you in the next one. Until then, bye.